$45 sounds like a fee you can absorb. Annoying, maybe, but not alarming. Now add the missing part. The fee buys access to only $300, and the whole repayment is due in 14 days. Federal consumer agencies use this exact kind of example to show why a typical payday loan can equal an annual percentage rate near 391%. The loan does not last a year. The APR is a comparison lens. It forces a very short, very expensive fee onto the same annual scale used for other credit. The hidden price is not just $45. It is $45 for 2 weeks. Here is the basic mechanism. You receive $300 today. The lender charges $15 for every $100 borrowed, so the finance charge is $45. You may give the lender a post-dated check or authorize an electronic debit from your bank account. 14 days later, the amount due is $345, usually in one lump sum. 3 numbers describe 3 different things. $300 is the cash you receive. $45 is the cost of borrowing. $345 is the repayment that must fit inside your next paycheck. If that full amount does not fit, the problem begins before the due date arrives. Now translate the fee into APR. First, divide 45 by 300. That is 15% for 14 days. Then put the 14-day cost onto a 1-year comparison scale. Multiply 15% by 365 divided by 14. The result is about 391% APR. This does not mean the borrower receives $300 and automatically pays $391 in interest. It means the borrowing rate is extremely high relative to the time the money is available. APR turns different fees and different loan lengths into one comparable number. Without the time scale, $45 looks small. With the time scale, the price becomes visible. Suppose payday arrives, but $345 is not available. Where state law and the loan terms permit it, the borrower may be offered a rollover or renewal. The borrower pays another $45 fee to move the due date. That payment buys time. It does not reduce the $300 principal. After one extension, the borrower has paid $45 and may still face another $345 at the next deadline. After 5 fee-only extensions, $225 has left the budget. The original $300 is still unpaid, and the next payoff can still be $345. If the borrower finally pays, then total fees reach $270. State rules vary, and many states limit or ban rollovers. The arithmetic is illustrative. The treadmill is the point. This is not only a theoretical pattern. In a Consumer Financial Protection Bureau study of more than 12 million storefront payday loans, more than 80% were rolled over or followed by another loan within 14 days. 22% of new loans were renewed 6 times or more. At a typical 15% fee, an initial loan plus 6 renewals creates fees greater than the original amount borrowed. That research describes the data the Bureau studied. It is not a live count of every loan today, but it exposes the business logic. The product can look like a one-time bridge while the revenue comes from repeated trips across the same short gap. Before taking the loan, ask one question in plain language. Can the budget repay $345 in 14 days without borrowing again? If the answer is no, approval speed does not solve the shortage. The CFPB and FTC suggest checking alternatives first. Ask the company you need to pay whether it can extend the due date or accept a smaller payment. Check whether a bank or credit union offers a lower-cost small-dollar option. Ask an employer, nonprofit, or community group about an advance or emergency assistance. Even partial help from family or friends reduces the amount exposed to the high fee. If a payday loan is already difficult to repay, ask the lender about an extended repayment plan and check your state regulator for local rules and licensing. Before signing, write down 4 numbers. 1. The cash you actually receive. 2. The total amount you must repay. 3. The exact number of days until payment. 4. The APR. Then read the debit authorization and the rollover terms. A $45 fee is not small when it rents $300 for only 14 days. The hidden receipt is time. Read the fee. Read the clock. Build the exit before you borrow. Subscribe for the real price behind the convenient number.